Welcome to the video. Today we unpack the 529 paradox. What to do when a child's 529 plan is already overfunded long before enrollment. We will explain why this situation calls for a shift from growth to capital preservation, show you how to de-risk, and explore flexible alternatives for any excess savings. We will also walk through multi-generational strategies and include quick knowledge checks along the way. Here is our roadmap for today. First, we will define what it means to win the 529 game. Next, we will discuss why and how to reduce risk once the goal is secured. Then, we will explore alternatives for excess funds. After that, we will examine uses beyond undergraduate tuition and illustrate a sample allocation and glide path. We will include quick quizzes and finish with practical key takeaways. This content is educational and does not constitute financial, tax, or legal advice. Your decisions should be based on your own circumstances, goals, tolerance for risk, and consultation with appropriately credentialed professionals. Winning the 529 game means your current account balance, when measured against conservative projections for tuition inflation and total attendance costs, is sufficient to pay for the education goal. Unlike retirement, which can span 30 years or more, a college fund has a fixed, near-term deadline and a relatively clear cost ceiling. When the math confirms sufficiency, the rational move is to protect the required capital rather than pursue additional return that you do not need. There are 4 primary reasons to de-risk promptly after securing the goal. First, the time horizon is fixed, and market returns are unpredictable across short windows. Second, the cost ceiling is defined, so additional growth becomes optional rather than necessary. Third, risk is now asymmetric. The potential harm from a drawdown outweighs the incremental benefit of additional gains. Fourth, less volatility helps you avoid panic decisions during downturns. Collectively, these factors point to preserving capital once the goal is met. Here is a practical sequence. First, stop making new contributions if the goal is fully funded. Second, reallocate away from high-risk equities and toward more stable fixed income and cash-like instruments. Third, as a starting point, many investors target around 80% in stable assets and the remainder in modest growth, but the right split depends on your risk tolerance and timing. Fourth, build a semester-by-semester withdrawal ladder so tuition payments are matched to highly stable funds. Lastly, rebalance and review annually or after significant market movements. Once the 529 is fully funded, redirect incremental savings to more flexible vehicles. A taxable brokerage account provides unrestricted use and access to long-term capital gains treatment for qualified holdings. If the student has earned income, a Roth IRA is powerful because contributions can be withdrawn at any time without tax or penalty, and qualified withdrawals of earnings are tax-free later. As an advanced option, current law allows certain rollovers from a long-held 529 to a Roth IRA within lifetime and annual limits, and subject to detailed eligibility rules. For short-term non-education goals, high-yield savings or cash equivalents maintain liquidity. Before finalizing a de-risking plan, consider the full flexibility of 529 funds. They can be used for graduate degrees and approved vocational or technical programs. They can also support later life education or career certifications if plans change. Beneficiaries can be changed to eligible family members, making funds available to siblings, cousins, or other relatives. For affluent families, 529 plans can play a role in multi-generational education funding and can offer estate planning advantages, including potential benefits related to generation-skipping transfer strategies. A simple conservative split is 80% in stable assets and 20% in equities. The stable portion can include short-duration bonds, money market funds, or treasury bills. The small equity sleeve maintains some growth potential and helps with inflation, but is sized so that a downturn does not jeopardize tuition. Align cash-like buckets to immediate bills and place later semester funds in short-term bonds for a measured balance between stability and modest yield. This timeline illustrates a glide path that starts with higher equity exposure during earlier years, transitions to materially lower equity and higher bonds and cash during the middle years, and culminates with a heavy preservation stance as college approaches. The near-term semesters are intentionally matched to cash-like holdings to reduce the risk of having to sell after market declines. The structure aims to minimize the chance of a last-minute shortfall. This illustrative table breaks the portfolio into functional buckets. The first 2 semesters are covered by very low-risk, cash-like holdings. The next 2 semesters move out the risk curve slightly with short-duration bonds. The remainder section continues to rely on fixed income to preserve capital for later expenses. Finally, a modest equity sleeve remains for optional growth and inflation protection. Percentages are examples and should be tailored to your circumstances. Here is a side-by-side comparison. Remaining aggressive could generate additional returns in a rising market and may feel simpler if you already hold equities. However, it carries substantial drawdown risk as tuition deadlines approach and can induce behavioral errors. De-risking prioritizes goal protection, reduces volatility, and better matches assets to liabilities, though you may forego upside if the market rallies and must commit to ongoing planning and rebalancing. Quiz time. If your 529 balance already covers projected costs with conservative inflation, what is the first recommended move? Options. A. Keep contributing and stay 100% in equities. B. Stop new contributions and shift towards stable assets. C. Borrow student loans to preserve the 529. D. Convert the 529 to cash and withdraw immediately for non-education uses. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is B. If the goal is funded, stop new contributions to the 529 and begin shifting towards stable assets to protect capital. Second quiz. After the 529 is fully funded, which account generally offers the greatest flexibility for new savings? Options are A. Another 529 account. B. A Roth IRA regardless of earned income. C. A taxable brokerage account. D. A certificate of deposit with early withdrawal penalties. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is C. A taxable brokerage account provides the most flexibility for new savings since it can be used for any purpose. Roth IRAs are powerful but require the saver to have earned income and have additional rules to observe. These are the key takeaways. When the goal is funded, protect it. Shift allocations towards stability and align buckets to specific tuition due dates. Redirect incremental savings to flexible accounts, such as a taxable brokerage, and consider Roth IRAs if eligibility is met. Remember the broader 529 flexibility for graduate studies, vocational programs, and beneficiary changes with potential multi-generational benefits. Finally, schedule periodic reviews and rebalancing to keep risk aligned with the timeline. In summary, college savings differ from retirement because the horizon is shorter and the cost ceiling is clearer. Once you have funded the target, de-risk to secure the outcome and reduce drawdown stress. Direct future savings to flexible vehicles. Keep in mind the broad utility of 529 funds, including graduate studies, career pivots, and beneficiary changes. Protect your win and maintain a simple, resilient plan. Thank you for watching. If you found this helpful, please like the video, share it with someone who is planning for college, and subscribe for more content. I would love to hear your questions, scenarios, and strategies in the comments.